Nigeria's debt stock has been on the rise since the country secured a debt pardon from foreign creditors in 2006. The country's debt stock now stands at 21.7 trillion naira.
And within the space of 6 months between June 2017 and December of 2017, Nigeria's debt stock jumped by 10.6% from 19.7 trillion to 21.7 trillion naira. The World Bank has expressed concerns over Nigeria's increasing debt burden as the country now spends about 63% of its revenue on debt servicing alone. Data from the Debt Management Office revealed that the federal government spent the sum of 1.48 trillion naira on debt servicing in 2017.
Now, the World Bank says it is worried that Nigeria might not be able to sustain the trend and the economy may go under. But contrary to the position of the World Bank on the high interest on loan, the Minister of Finance, Mrs. Kemi Adeosun, says there is nothing to fear about the rising debt. In fact, Adeosun says the federal government's revenue and debt management strategy would mitigate the country's debt service risk and fast-track development. All right, joining us now from our Abuja studios, a professor of economics and a macroeconomic policy analyst, Professor Ken Ife. Professor Ife, it's good to have you join us right now.
Thank you very much.
Okay.
Could you increase your volume, please? I can hardly hear you.
All right. I think that the IT, those who are in charge will listen to that and work on it. But let me come to you fast on this. Nigerians are quite very confused sometimes when the World Bank or IMF sometimes talk about the issue of the GDP to, or the debt to GDP, ratio is not too bad yet. And then sometimes they come back to warn Nigeria about the debt profile and debt stock, as the case may be. How do they go side by side?
Well, it's not unexpected that I would hear both World Bank and IMF cry foul at some instance. But what I have to assure you is that after the sad experience of 2005, when we exited the Paris Club, Nigerians went to the law to make sure that they can guarantee low fiscal stress and low risk, external risk. And that is by Fiscal Responsibility Act that placed, first and foremost, all external borrowing should be for capital project. So that's number one. Then number two is that the debt servicing should not be more than 3% of the GDP. That's Fiscal Responsibility Act. But what you cannot legislate against is external shocks on your revenue. So that's where we continue to have concerns. We know that when you look at global thresholds, Nigeria is by far away. It's 40% of external debt to GDP. We're very low. And also 40% of debt servicing to revenue. That's where you have small challenge. Sometimes you have a spike going up to 60% and then down again, and it's because of external shocks in our revenue. And at the same time, low collection of revenue collection from FIRS at those times, and also from customs revenue, and even VAT tax. And that was when the economy was so down that our foreign reserve was around $25 billion. But now foreign reserve is 48-point-something billion and likely to hit 50 billion by the end of the year. But that is not to say that we have to shy away from widening the tax base. This is the problem. The problem is that the tax to GDP revenue is very low, at under 6%, compared to the average in Africa of about 15%. And most countries are between 18 to 24%. And the government is tackling that. They've done amnesty and they're increasing revenue. They also need to increase some VAT. We are the lowest VAT at 5%. So we got to get that up. Many West African countries are even at 15% VAT. So it's very important that we raise those revenue base so that the size of the budget for the country will be reasonable. It's very, very unreasonable. At 7 trillion, we should be around 20 trillion naira. So it's very, very low. But having said that, there are encouraging things about our debt profile. One is that in the infrastructure, we are deregulating virtually every infrastructure and encouraging PPPs in every aspect of our infrastructure. You've seen the power is all in the hands of the private sector, except, of course, the transmission lines. You see the road, there is more tendency to get PPP on roads. Railway is not a problem because it's a revenue generation investment. And neither is water supply, revenue. They're all revenue. So even in the power, there's revenue. But what we need is to up the ante. And I don't see or cherish the panic alarms that I hear. They're not necessary.
Okay,
because the country
let
is
me
trying,
come in.
and we must continue to invest. And even if you look at the...
Yeah, Professor Kenife, the World Bank and the IMF have been saying, yes, there's nothing wrong with borrowing and, piling up the debt if it actually goes to infrastructure development. But if you continue to pile up the debt and you don't diversify your revenue sources, plus the major challenge of interest payment, which is a huge chunk of government's revenue and income, aren't you troubled by that?
Of course I'm not. Why? Because there is a plan. We have an economic growth and recovery plan. And that plan actually dimensioned debt sustainability. It looked, first of all, to borrow to retire some of the domestic debts, which is fine. And then it also looked at rejigging or rebalancing external and domestic debts in favor of external debts, because that rejigging of moving external debts to about 40% and reducing the domestic debt, which is crowding out investment to 60%, could free as much as $168 billion. And don't forget that those external debts are actually low interest constituencies. Some are 0%, 1%, 5% at the most, compared to the atrocious interest they are paying in the domestic debts. So there is that balancing. And then there's also other things within the plan itself to raise revenue, to diversify our revenue base. And as you've seen it, a lot of investment has gone into agriculture, the export has gone up, foreign investments are flowing in, and you see recovery. Even the one window, import-exporters window alone, so the investor-exporter window alone is putting a lot of currency to stabilize the forex market and allow more accretion to the foreign reserves. We thank God and touch wood. I hope the prices of oil will continue to rise, and they're increasing accretion to our foreign reserve. So all of those, we are not sitting idle, doing nothing. And the government is looking at getting rid of a lot of the projects and then getting them into the private sector domain so that we can leverage private sector investment and bring more efficiency and productive capacity to the private sector. So all of those are happening at the same time. But we're not going to stand still. There's no way we're going to stand still because one or two people are crying. We'll take those. We won't throw caution to the wind. But we need to grow our economic base, so that the MSMEs will have a field day and increase competitiveness in the economy.
Yeah, but how do you grow? How do you grow the economy? How do you grow the economy?
Necessary infrastructure, you empower the private sector.
Yes, how do you grow the economy really, and a sustainable economy at that, if the huge infrastructure gap is still there? Yes, government says it wants to borrow some $2.5 billion to, of course, it will be converted to Naira to pay off the debt stock and all of that. But the infrastructure gap is huge. It's humongous. The rail is not there. Power sector, which you were just about to talk about, is not necessarily where it should be. How do you ensure that with all of this borrowing, that Nigeria's economy really can grow?
Well, I have explained that first of all, the law restricts that external borrowing to capital projects, which is the good point, because that means you're going to have more employment because capital expenditures. Secondly, a lot of those that are going into infrastructure must be economic infrastructure. That is, they should be able to pay. If the infrastructure you are investing external borrowing into is capable of retiring the debt, we haven't got an issue. You know, you put in rail, you collect revenue from rail, you move long haulage, you reduce the cost to the economy of that 20% input cost because of transportation. So the economy grows. You bring power, you pay for the power because we have economic rates being charged you know, for the power consumption. And those people are coming in because they are now seeing that the rates being charged are reasonable. So they can invest on those bases. But then that reduces 40% input cost to manufacturing activity just by having more power. So you're growing the economy. So you can't escape investing in infrastructure. But what we want to do is to ensure that those infrastructure you invest in are the ones that are capable of retiring the debt. So they're going to be profitable. Or get the private sector to manage them. The roads, you get them in PPP. So, you know, that's the issue. But if you just go and borrow it and drop it in areas where you cannot recover the cost, it becomes a big challenge.
All right,
because
Professor,
there's so much competition for resources.
Yeah. Professor, the Debt Management Office raised the concern, and they said that the issue of Eurobond has shot the debt profile from about 12 trillion naira to 21 trillion naira we're talking about now since the last 1 year. But if you look at it from the eyes of Nigerians, they don't feel there is justification for that amount of money that has led to the debt profile or that debt stock rising that high within this short period of time.
No, I don't agree with that. I don't agree with that because you go to invest in infrastructure to grow the economy. The projections on Nigerian economy is that by 2030, it will grow from the $440 billion to $1.6 trillion. And by 2050, it will grow to $6.4 trillion, making you the 10th largest economy in the world. You can't get those without investing on infrastructure and opening up the economy and diversifying the economy. There's no way the oil levels or revenue levels in oil alone can grow you to those levels. So that's the point. And so as while you are increasing the tax base, you also have to increase the number of companies and the size of the companies that are able to pay those taxes by investing in low costs or competitiveness in the economy, by giving them the infrastructure that are necessary for them to grow their business. But the test is the infrastructure you're investing money on capable of retiring the debt? Now, if you're talking about debt level, let me tell you something. America GDP at about $18 trillion, their debt level is about $17 trillion. Look at UK. The external debt is about $87 billion. And there's France, 81 billion, Japan, 120 billion, Spain, 120, 150 for it. The thing is this, and when you add the domestic debt of UK to the external debt, the ratio becomes 500%. But the issue is not, you can see that they all violate the baselines and thresholds, but they are able to pay. And they have not allowed the macroeconomic management to bring in stress or default. So you know, it boils down to, are you actually developing, growing the economy with the borrowing that you are taking, and are you actually able to retire that borrowing from the activity that you have borrowed the money for? That is the litmus test. But we can't stop our economy from growing because it will be, you know, it will be devastation. We've got so high level of unemployment. It's by growing the economy that you create the jobs. You have huge resources, 198 million people, and you say they're going to stay on 7 trillion budget, and it's not possible.
But the countries you've just mentioned, Japan, the United States, the UK, and all of that, these countries all have infrastructure, the kind of infrastructure that rightly can help in retiring the debt, you know, just like you said earlier. From all indication, do you see a situation where Nigeria truly is not just paying lip service to diversifying the economy, for example, because all of our, the revenue we're making for now, yes, oil is going up to about $72 per barrel and what have you. It remains our only source of income. Can you say that we're truly diversifying the economy in such a way that it can help us, you know, not only retire the debt, but actually stay out of debt?
the infrastructure encourages foreign investors to come in. It's not infrastructure for government to increase this revenue ab initio. It is for you to encourage investments to come in. And look at, for example, Africa Free Trade Area, which is a new thing that has been signed. When Nigeria joins, you suddenly find out that over half of all the people that want to invest in heavy industry in Africa are going to be coming to Nigeria, because our 200 million population guarantees them market for their goods. So they're going to be heading in here. But how are they going to head in when there's no power? How are they going to head in when they can't even move their goods from one location to the seaport?
All right,
and
Professor,
they go to a congested
let me
seaport,
ask you this before we
thanks
leave.
to Lekki deep sea ports and other deep sea ports that are in the pipeline.
All right, Professor, I'm afraid this is the much we can take right now. Time is no longer on our side. But we must thank you, Professor Kenny Fair, an economist. Thank you for joining us from our Abuja studio.